What just happened is far more important than a single corporate transaction. It marks a structural shift in North American energy that almost nobody in Washington is talking about. And that silence is dangerous. In late November 2025, Canadian oil producer Baytex Energy quietly announced it was selling its entire Eagle Ford shale operation in Texas. The price, $2.3 billion USD. The deal closed December 19th. On the surface, it looked like a routine asset sale. But when you zoom out, the implications are staggering. Just 2.5 years earlier, in February 2023, Baytex paid $2.5 billion to acquire Ranger Oil, specifically to gain exposure to Eagle Ford. That means the company willingly accepted a minimum $200 million loss, before factoring in operational costs, integration expenses, and capital spending over those 2 years. No energy company walks away from nearly half its production footprint unless something fundamental has changed. And make no mistake, this was not a marginal divestment. The Eagle Ford assets represented 44% of Baytex's total production, roughly 83,000 barrels of oil equivalent per day. According to Enverus Intelligence Research, this single transaction eliminated nearly 2/3 of Baytex's enterprise value. That is not portfolio optimization. That is a strategic retreat. Even more concerning, the buyer remains undisclosed. Baytex has refused to name who acquired the assets. Industry analysts widely believe the buyer is a private equity or financial firm, not a long-term operator, but a cash flow maximizer. These firms specialize in extracting value from mature assets, minimizing reinvestment, and exiting within 5 to 7 years. Why does that matter? Because Eagle Ford spans 26 counties in South Texas, employing thousands of workers directly and tens of thousands indirectly. When a producing asset shifts from an integrated energy company to a financial owner, the priorities change. Exploration budgets shrink. Maintenance gets delayed. Workforce reductions follow. For local communities, that uncertainty is immediate and personal. Now, zoom out to the bigger picture. Canada is the largest foreign oil supplier to the United States, accounting for 62% of all U.S. crude oil imports in 2024, more than 4.1 million barrels per day. Canadian crude represents 25% of total U.S. refinery inputs nationwide, and in the Midwest, that figure rises to 65%. So when a major Canadian producer decides it would rather take a massive loss than continue operating inside the United States, it raises a critical question. What changed in the economics of U.S. shale? The answer starts with decline rates. Shale production operates on a treadmill. A typical Eagle Ford well can lose 70–80% of its output within the first year. To maintain production, companies must continuously drill new wells. That requires constant capital investment. Baytex's own guidance revealed the contrast. Its Canadian assets, particularly the Clearwater and Duvernay plays, generate internal rates of return exceeding 50% at current oil prices, with far lower capital intensity. In plain terms, higher profits, less risk, better predictability. Meanwhile, U.S. shale has hit a ceiling. According to U.S. Energy Information Administration data, American oil production has plateaued around 13.2 million barrels per day. The best drilling locations, Tier 1 acreage, are largely exhausted. What remains costs more and produces less. Baytex made a calculated decision: compete in a maturing U.S. shale basin with declining returns, or consolidate capital in Canada, where the economics are superior and export infrastructure is expanding. They chose Canada, even at a steep short-term cost. And that decision is not isolated. It is the leading indicator of a broader restructuring in North American energy ownership. This brings us to the second force reshaping the industry: The rise of private equity in oil and gas. In 2025, private equity-backed firms accounted for 35% of upstream energy transactions in North America, more than double their share in 2020. These buyers are not planning decades ahead. They are harvesting cash. This is the transition from growth to extraction, from building capacity to milking decline curves. And once that shift accelerates, it is extremely difficult to reverse. What Baytex just did may look like one company exiting one basin. In reality, it signals that U.S. shale has entered its harvest phase. And that has serious implications for workers, refineries, prices, and long-term energy security. And that's exactly where this story goes next. Now, let us talk about who is really buying American energy assets, because this is where the story becomes deeply uncomfortable for U.S. policymakers. When a major producer like Baytex exits, the assets don't disappear. They change hands. And increasingly, they are being absorbed not by traditional energy companies, but by private equity and financial buyers whose incentives are fundamentally different. These firms are not betting on American energy dominance. They are betting on short-term cash extraction. Here's how the model works. Private equity targets mature shale fields that are still producing large volumes but have limited undeveloped inventory. They slash capital expenditures, reduce drilling activity, optimize staffing, and extract as much free cash flow as possible. Exploration budgets drop. Long-term field development becomes irrelevant. The goal is yield, not resilience. According to Enverus data, private capital accounted for 35% of all upstream oil and gas deals in North America in 2025, up from just 15% 5 years earlier. That is not a coincidence. It reflects a structural shift. Institutional capital no longer believes U.S. shale offers long-term growth, only harvestable decline. This is what analysts mean when they say the shale revolution is over. Not that oil production stops overnight, but that the industry has moved from expansion to liquidation. And the human consequences of that transition are real. In regions like South Texas, ownership changes almost always precede workforce reductions. Financial operators do not maintain redundant supervisory layers. They do not invest aggressively in new drilling programs. They manage decline curves. A conservative estimate suggests that for every 10,000 barrels per day of production transferred to financial ownership, between 50 and 100 direct jobs are at risk, with an additional 200 to 300 indirect jobs affected across trucking equipment, servicing, hospitality, and logistics. For families built around the shale boom, this is devastating. Entire towns expanded during the 2010s under the assumption of continued reinvestment. Housing markets, schools, and small businesses were built on the expectation of stable energy employment. That assumption is now cracking. But the ripple effects don't stop at local communities. U.S. refineries are deeply exposed. Gulf Coast and Midwest refineries are configured specifically to process heavy Canadian crude. They've spent billions on specialized equipment, cokers and hydrocrackers, designed around that feedstock. Baytex's production was part of that supply chain. While the oil will continue flowing for now, refiners are nervous about long-term reliability when financial buyers control production. Private equity does not guarantee supply stability. They guarantee cash flow. Any uncertainty in crude supply planning translates into higher risk premiums, increased hedging costs, and ultimately higher prices for consumers. And here's the strategic vulnerability Washington is barely acknowledging. The United States imports more oil from Canada than from all OPEC nations combined. Canada supplies roughly 62% of U.S. crude oil imports. OPEC supplies less than 12%. That means America's energy security is far more dependent on Canada than on the Middle East. Yet U.S. trade and regulatory policy increasingly treats Canada as expendable. This is where recent tariff threats matter. In early 2025, the Trump administration floated 25% tariffs on Canadian energy, later reduced to 10% after backlash. Even though those tariffs were softened, the signal was clear. Cross-border energy integration is now politically vulnerable. For Canadian producers, that uncertainty is toxic. Capital flees uncertainty. Baytex didn't exit because tariffs were imposed. It exited because the risk of future disruption became unacceptable. At the same time, Canada has been building alternatives. The Trans Mountain Pipeline expansion, completed in 2024, now allows Canadian crude to reach Pacific markets. LNG Canada is ramping up global exports. Canada is quietly positioning itself not just as America's supplier, but as a global energy exporter. This is the pivot few Americans see coming. If Canadian producers increasingly focus capital at home and orient exports toward Asia and Europe, the U.S. loses more than barrels. It loses leverage. It loses reliability. And it loses the assumption that Canadian supply will always default south. Energy economists warn this shift could have tangible consumer impacts. A C.D. Howe Institute report projected that if Canadian supply diversification continues, Midwest gasoline prices could rise 10 to 15 cents per gallon within 2 years, simply because refineries lack alternative feedstock options. That may not sound dramatic until you multiply it across inflation-sensitive supply chains, transportation costs, and manufacturing inputs. And remember, U.S. production is already plateauing. There is no surge coming to offset decline from mature fields, which brings us to the most uncomfortable question of all. If U.S. shale is entering its harvest phase, if private equity is replacing producers, if Canadian majors are consolidating northward, who exactly is planning America's long-term energy future? Because right now, it looks like no one is. And that's where this story gets even bigger. Now, let's step back and look at the systemic risk this creates for the United States, because Baytex is not an isolated case. It is a signal. U.S. shale production has not collapsed, but it has stalled. According to the Energy Information Administration, total U.S. crude output has hovered around 13.2 million barrels per day for more than a year. The explosive growth phase that defined the 2010s is over. The industry has drilled through its best acreage. What remains are Tier 2 and Tier 3 locations, wells that are more expensive, less productive, and far more sensitive to price volatility. Maintaining output now requires significantly more capital for diminishing returns. That reality collides directly with today's financial environment. Higher interest rates have changed how capital flows into energy. Investors are no longer rewarding production growth. They are demanding cash discipline, dividends, and buybacks. That makes long-cycle reinvestment unattractive. It also makes mature assets perfect targets for financial buyers and unattractive for long-term operators. This is why Baytex's decision matters so much. They looked at U.S. shale and saw a future of rising costs, regulatory uncertainty, and declining marginal returns. They looked at Canada and saw the opposite: higher margin plays, regulatory clarity, and growing export optionality. That is a rational decision, but it has consequences for America. Energy security is not just about producing oil. It's about controlling the conditions under which oil is produced. When production migrates toward financial ownership, control weakens. When foreign producers redirect capital elsewhere, resilience erodes. Now let's talk refineries, because this is where theory turns into pain. Midwest and Gulf Coast refineries are structurally dependent on heavy Canadian crude. They cannot simply replace that supply with light shale oil from the Permian or Bakken without costly retrofits. We are talking years of construction and tens of billions of dollars. So when Canadian producers signal that U.S. markets are no longer their default priority, refiners see risk, not today, but tomorrow. That risk gets priced in. Hedging costs rise. Long-term supply contracts become harder to secure. Eventually, consumers feel it. Energy markets don't break loudly. They tighten quietly. Now add geopolitics. Canada has spent the past 5 years systematically expanding its ability to export energy without relying on the United States. The Trans Mountain Pipeline opened Asian markets. LNG Canada gives access to global gas buyers. Europe, desperate to diversify away from Russian energy, has become a willing customer. From Ottawa's perspective, this is strategic insurance. From Washington's perspective, it is a slow erosion of influence. And here is the part most Americans are not being told. Canada is not doing this out of hostility. It is doing it out of necessity. Trade policy volatility forced Canadian firms to treat U.S. access as uncertain, and capital does not tolerate uncertainty. Once that capital builds alternative routes, it does not come back easily. Energy economists warn that this is how dependence flips. The U.S. once assumed Canada needed American markets more than America needed Canadian supply. That assumption no longer holds. And now we arrive at the political contradiction. The U.S. wants energy independence, but refinery infrastructure locks it into Canadian crude. The U.S. wants leverage over allies, but leverage pushes those allies to build exits. The U.S. wants cheap fuel, but policy uncertainty raises long-term costs. These goals cannot all coexist. Short-term political signaling has long-term structural effects. And energy markets, remember. Analysts at the Kansas City Federal Reserve put it bluntly in a May 2025 report. There is no near-term substitute for Canadian crude in the Midwest. Even aggressive domestic drilling would not solve the mismatch in quality and logistics. That means energy security is no longer purely domestic. It is bilateral and increasingly fragile. Which brings us to the most dangerous phase of this transition: the lag effect. Nothing breaks immediately. Wells keep producing. Gas stations stay supplied. Prices fluctuate but remain manageable. That creates complacency. But underinvestment compounds. Workforce reductions reduce operational resilience. Decline rates accelerate. And when disruption finally appears, it appears suddenly. Energy crises are rarely caused by a single event. They are caused by years of quiet decisions that align in the wrong moment. Baytex's exit is one of those decisions. Not catastrophic on its own, but dangerous in aggregate.